Everyone could take their seats, please. I call to order the tonight's meeting of the Community Unit School District 201, November 8th, 2011. Roll call, please, Mrs. McMahon.
Mr. Armstrong?
Here.
Ms. Caparelli? Here. Mr. Charleston?
Here.
Mrs. Charlton?
Here.
Mrs. Hancock?
Here.
Mr. Price?
Here.
Mrs. Thomas?
Here. We could stand for the Pledge of Allegiance, please.
Pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Are there any public comments? Okay, the first item on the agenda is the consent agenda. Any questions, comments? Then the chair will entertain a motion to approve the consent agenda as presented, including one item, personnel recommendations.
So moved.
Second.
Roll call, please.
Mr. Armstrong?
Yes.
Ms. Caparelli?
Yes.
Mr. Charleston?
Yes.
Mrs. Charlton?
Yes.
Mrs. Hancock?
Yes.
Mr. Price?
Yes.
Mrs. Thomas?
Yes. Okay, next item on the agenda is the facility planning update.
Steve Cashman apologizes. He couldn't make it this evening, but is willing to come to future meetings that the board would like. But where Steve is at, you were sent a copy electronically of the concept he's been working on for South, which includes the shared space for marker for District 201 offices, as well as some thoughts about early childhood for the other portion of the building. The timeline that he's is working on, and right for just ease of conversation, what he's looking at is if he thought of this as just one project, so even the work at the high school, Miller, Manning, the South, if you thought of it as just one project, scope, schematic design, that would be completed by February with hard numbers, and then awarding contracts in March. So we'd go to bid, the board would have the opportunity to review those bids, and then March award contracts. And that does keep us on that timeline of having work completed for the opening of school in 2012. When we're in closed session, because of some of the leasing that's involved in it, we can look at possibly other variations on that timeline if we want to separate South from that. So, but I would recommend we have those conversations because of the lease implications in closed. But that's kind of what he's looking at, and work is being done on those other concepts as well. But he knows that one of the most time sensitive is the South Elementary and moving administrative offices and meeting the timelines of marker and 201. So any questions on that?
Have you met with Marker? Is that where this is coming from? Is this something we
Right.
can talk about here?
Kim, I had a conflict, and they were fortunate enough to wrap up before my meeting was over. But Kim and Steve Cashman, as well as Marker Superintendent and Business Manager, yesterday they met, looked at the concept, and basically this is, initially Steve had some conversations with Kim and I and Linda and Mike, and started to develop some concepts, and then we met with Marker, so it was refined a little bit more based upon those conversations. So
Okay, great,
they've been included in the process.
great.
Kevin, so we have you sent a plan in a board update, and then there's the most recent plan. So C is the one that's
Most recent, right?
most recent.
Right.
So you're not really looking at a choice of A or C or anything like that. You're looking at the progression of
Right,
planning.
exactly.
So the main difference here is obviously moving the student services office down to the lower level.
Right.
And, I mean, the only reservation I have about that is taking up a portion of the classroom space, and that was the largest classroom. I know it's pretty much divided like that already, but I did have a little concern about that. And I wondered, just looking at the plan, that back kind of entranceway on the main corridor, was there ever any thought given to closing that portion of it up and just making more space?
You know, that hasn't been part of the conversation, and I think we need to, you know, consult with Steve Cashman and make sure
Right.
that we're not going to violate any fire codes or anything like that. The thinking behind moving student services director to the lower level is, as we're kind of looking at this in this concept, we want one entrance for the district office, and then a second entrance for when, you know, early childhood students are arriving. And as part of the conversation, we thought definitely you would want somebody there as well, you know, to kind of meet and greet and direct people as they arrive. And because of the connection to the early childhood program, it made sense to locate the director of student services in that space. And so that's, you know, some of the thinking going into that location.
You know, I had some of the same questions. So one of the things that we've talked about in the future is the possibility of going for all-day kindergarten and that. Do you feel that there's enough space in what's listed there now as kindergarten? Obviously, that wouldn't have to stay kindergarten. Do you think, is this something when you're walking in the building and that, do you think that that looks like there's enough space there for that?
I think so. I think it does. I mean, it is an oversized space, and, you know, Grant, you are losing some square footage, but it still is ample space.
Okay.
I have a question on the schedule here. So if I'm reading this correctly, the shared space would be, you know, there's a breakout of 201 space, a breakout of 60 space, and then the shared use is a total of 3,016 square feet. Is that right? Yes? Okay, that was my only question.
Well, all in all, I
I
think.
think my question goes to, so if we are planning to move early childhood First Start all to to South by 2012, correct?
That, you know, is part of that leasing conversation.
Okay.
And so that impacts that timeline as to when that will occur. That's dependent on the lease and how the board wants to handle that piece.
Okay, so we still haven't crossed that bridge.
Right.
Okay.
I thought this looked great. I mean, especially, you know, like you said, you've talked with District 60 and all of the people that would use the space, so. Okay.
All right.
I've got it on there. Okay, the next item on the agenda is financing options for facility projects.
Sure.
Thank you.
And with us is Liz Hennessy with Green Beard, and she's going to walk you through the presentation and then be available for your questions.
Thank you.
Thank you, Liz.
Thank you.
Thank you.
Okay, well, thank you for having me back. I got some options to look at tonight that are both non-referendum options as well as some referendum options for a little bit smaller amounts than we were looking at last summer. But let's start under tab 1, and I'll just kind of go through our market update. The good news is interest rates have stayed pretty low. I think as long as the markets keep worrying about this sovereign debt crisis with Greece and Italy, we're going to see volatility in the market, and it's going to keep our investors fleeing to quality, meaning going to U.S. Treasuries, driving those yields down, and our municipal market follows along. So I think we'll continue to have strong rates. What you've got on page 3, the green line is the 20-year municipal market data for AAA-rated issues, and the blue line is the 10-year municipal market data index. Page 4 looks at our yield curve, and you can hardly see that dashed orange line because it's right under last year's yellow line, but we are at or near all-time lows for interest rates starting from year 1 all the way through year 30, and the lowest rates are really in the first 10 years. Going to section 2, the first slide, page 6, shows the district's currently outstanding debt service and tax rate. And if you start on the left-hand side of the page, I have the fiscal year and then the tax year or levy year. And I wanted to make that distinction because when we look at new bond issues, we really focus on the levy year, the tax year, because that's how the county clerk puts the new levy for a bond issue on. But we want to make sure we understand that what fiscal year it applies to. So for example, for the current fiscal year, you are receiving tax money from levy year 2010 for bond issue purposes. So the levy from 2010 comes in June of 2011 and in September of 2011, which relates to the fiscal year 2012. Okay, so there's kind of like a 2-year gap there. And then we go to the EAV, and for 2010, the EAV did decrease 6.9%, not unlike other municipal entities in finally getting the effect of lower housing values and the housing crisis that really started in 2008. It takes a while for those values to adjust down. And I know Kim has had some conversations with your assessors, and this most recent projection of EAV is quite conservative, but it looks like next year you'll also have a 7% decrease in EAV, followed by possibly a 14% decrease in 2012 levy year. Then we kind of just eased those decreases back, Kim and I together kind of looking to the future, when will growth start, and then secondarily, when will that growth start to show up on the tax rolls, because there's again that delay. So, you know, with less certainty in the longer years, we projected -7% in 2013, -2% in 2014, and then kind of going back up to 1% and a 2% kind of normalized growth pattern thereafter. So again, the further out we get, the less certainty, but we do know EAVs and the effect of the 2008 recession that's ongoing has resulted in decreases in the EAV and, of course, the corresponding increase in the tax rate.
So this depicts as much as a 31% additional drop in EAV beyond this year.
Yeah, and that was updated information that I received last week meeting with the assessors. So significantly different than the information they gave us a year ago.
Yeah, because just purely as an observation, we have EAV of nearly $550 million or market value of real estate in the district of about $1.65 billion this year. We don't get back there for 20 years. 20 years.
And
again, we see those values again.
There's less certainty with how things will grow and how we'll recover, you know, after the next 3 years or so that the assessor can speak to. So
even so, I mean, negative. If even these early losses are real, I mean, those losses are hard to make up. They take forever. So.
Right.
unless inflation kicks in and
Well, I'm
those
curious
housing-
about that as well. You do have a 3% CPI number in there. I'm curious about that.
Well, that's kind of what's tracking for the 2012 levy year.
Is it?
Right, and we'll know that for sure in January, because for the 2012 levy year, we're going to look at what...
2011 CPI?
Yes, from
Okay.
December 2010 to December 2011. And I think it's even tracking a little bit higher than 3% right now, so,
A little bit.
yeah.
And then just to take that further, it looks, like you're very conservative from there on out.
Yeah, and it's, it's been fluctuating all over
Right.
the place. We've gone from a high of 4.1 to a 0.1 to a 2.7 to a 1.5. So,
Right.
it's really anybody's guess at this point.
Yeah, okay.
Does that actually impact our ability to service debt, the EAV decreasing like that?
Not the EAV. Not the EAV, because these bonds are general obligation limited tax bonds that are payable from that debt service extension base. So if the EAV plummets even further, it just means that tax rate, instead of 22 or 26 cents, might be 30 cents or 31 cents.
Okay.
The thing that does impact us in the future is the CPI growth. So we've conservatively, after 2012, looked at 1.5%, where the historical average is closer to 2.5%. But like Kim said, we have had some pretty major swings, so we want to be thoughtful about what we project there, because that does affect the debt base and how much debt you can service and repay at any one time.
Kim, we have capped operating levies. With these kind of EAV decreases, do we approach our levy caps in any of our?
I'm not sure. I haven't run that yet.
Okay. And are we levy capped on this levy?
No, there's no rate cap
No
on the
rate
debt
cap?
levy.
Okay.
But being a unit district, you do have higher maximum rates than, for example, a single elementary district or a single high school district.
Yeah.
So hopefully,
And and most of them, Dan, we're not close.
I know we're not close now, but if
Right.
if 31% additional EAV decreases are real, I thought those are massive. Those are massive, and they could easily take the rate up. It's close to something near that cap.
just moving across the page, we have the outstanding non-referendum debt service, which is about $1,145,000 or so a year, and it's paid off by levy year 2015, which is the fiscal year ending June 30, 2017. Okay, so there's room in your debt base, little bits of room before that, but the big amount of capacity comes back in 2015. And then you see the debt service tax rate at the far right-hand side, and that is simply a function of the debt payment divided by the equalized assessed valuation. So as we see some of these decreases, you do see that rate creep up a little bit. But if you're a homeowner, your house is going down 7 or 14% too, however these turn out, assuming your house value is going with the average. There's always somebody whose house doesn't go down as far, or someone whose house gets devalued more because they protested their assessment. But on average, the dollars they pay are going to be the same for debt. So even though that rate's going up, their dollars that they pay are pretty much the same. Page 7 shows just a graph of that outstanding debt, and that line represents your debt service extension base, that's the DSEB, and the space underneath that line can be used to pay off additional bonds. And this is with levy years as opposed to fiscal years. Okay, so with regard to non-referendum bonds, you can issue those if you have debt service extension base ability, which you saw you do, and the district's base in 2011, which we know is $1,197,470, and this amount will increase with CPI annually. Non-referendum limited tax bonds are an extension of the currently paid debt service with a CPI factor added on. So from a taxpayer point of view, this is not increasing your debt like a referendum would as much. It's extending what you have been paying for a longer period of time. So
another way to hold that, I guess, is, the extension, that's the $1.1 million that's growing to $1.2 million, that's growing to $1.3 million over the course of years. Doing additional non-referendum bonds is really just a function of borrowing against that future revenue stream
yes.
today. It's pledging more of that revenue stream out.
Correct.
Today. Good.
And I already talked about the last payment of your current bonds. Let me just go through the types of limited bonds you can issue. Working cash is the most flexible and the most frequently used type of bond, especially if you're looking at construction projects that might not all qualify for life safety, which is the other most popular kind of non-referendum bond. So working cash fund bonds can be used for either capital or for operations, and it requires a petition period and a public hearing prior to issuance. So we need to kind of do those authorization steps. Life safety bonds, the proceeds must be used for life safety projects that are approved by the Regional Office of Education in DuPage County as well as the State Board of Ed. And it takes probably about 6 to 10 weeks to get those approvals done by your architect, submitted to the ROE, then it goes down to the state, and then it comes back to the ROE. So it's a process. But if your projects do not qualify for life safety, all of them, it's probably easier to issue the working cash. But life safety bonds require a public hearing, but no petition period. And then funding bonds can be used to refund obligations of the district, such as debt certificates or lease certificates. If you were looking at doing, if you had no working cash authority, for example, and you wanted to do a building addition or a building project, you could do this combination of debt certificates and funding bonds. It's actually 2 issues. You issue the debt certificates and they're callable at any time, and then you go through your petition process and public hearing and then refund them with funding bonds, and that puts it on the debt service extension base. We would recommend that course of action if you didn't have enough working cash bonding authority available to you to accomplish your projects, but I'm pretty sure you do. And then working cash is more direct, 1 bond issue instead of 2, less costly.
So you're using the word refunding, much like residential type language would be refinancing, effectively taking existing debt that exists, whether it's a certificate or whether it's something else, and paying it off with proceeds from the new funding bonds.
Right.
Okay.
So it's actually 2 issues.
That's just that
That's in the
last one.
funding bonds?
That's just
Yeah.
with the funding
It's just for
bonds.
funding bonds.
But like I said, we would recommend, because we believe you have that working cash authority, there's a state formula for that, to use a working cash because it's direct, it's more flexible, and it's less
It
costly.
also requires that the debt that you're paying off is prepayable. So for instance, our existing bond debt that's out there for another 6 years, as I understand it, is not prepayable. Is that
It's not callable prior to maturity, correct?
meaning that? Yeah.
And the reason for
We can't
that-
prepay it even if we wanted to.
Well, you could, but it wouldn't make financial sense. You could escrow it to maturity, meaning
Oh,
set
you
up
could
a...
defease it, but yeah.
Right.
Okay.
But that would not make good financial sense at this juncture.
So you're suggesting that this issuance would be different, that we could pay it on a different schedule if we so chose?
It just, well, any new issues we're talking about are just, it's just new debt.
Right.
It's just new debt.
Right.
But does the new debt function the same way where the payment schedule is what it is and?
Where it's fixed,
Yeah.
yes, it's fixed rate debt typically. And if the bonds are more than 8 years to maturity or 9 years to maturity, then we would most likely have a call feature in it and have it, part of it, subject to optional redemption. But when we have issues that are 9 or 10 years only, the standard in the public finance industry is to have those bonds non-callable. And if you want them callable, you can make them callable, but oftentimes you'll pay an interest rate penalty for a short call. So So unlike a mortgage, which you can refund at any time, municipal bonds typically have that 8 to 10-year call protection for the investor. Otherwise, again, the interest rate would be higher.
So what you said, does not make good financial sense to go with that third option. It's better
Well,
to go
it
with the
doesn't make
working
sense to
cash.
go with the third option, but even on your new bonds, if your bonds are shorter than, 8 to 10 years,
Right.
then most likely they should be non-callable. If they're longer than 8 to 10 years, then we can definitely put a call feature on and would highly recommend that, because then you have the opportunity, if rates even go lower than they are now, that you could refund them sometime in the future for savings.
Liz, I'm sorry.
Sure, go ahead.
Can I ask you just a real quick question? I just want to go back to the debt service tax rate.
Yes,
So those numbers may go up based on the EAV.
based on our projection at EAV, yes.
So the numbers, did you say the numbers may go up, but the dollars
Right.
will remain the same?
Yes, because if you go back to page 6, the rate, as you can see, that the taxpayers are paying for 2010 tax year, which is paid in 2011, which people just paid, for example, in September.
Right.
That is about 21 cents, and the payment for that, the tax rate is 21 cents. The payment for that's about 1,143,000. The payments are all pretty much the same, as you can see in the
Right,
future.
right.
But because the tax base is decreasing, the tax rate is going up.
Okay.
But on your tax bill, you'll see this higher tax rate, or combined with your other tax rate, your operating tax rate. But the dollars that they pay should not be any different, because we've got level payments, as you see, for the debt.
Right, okay.
Okay, good question. It is confusing, and people
It's just a
sometimes.
calculation, It's just dividing a number by a number and.
Sure.
It's not a tax increase.
Well, I mean, it does grow by CPI, the way we grow our levies on other
Right.
stuff, right? So it is going up, and to the extent that we use it, we're going to have to continue to grow it. So it does go up.
Right, we're not getting really any more dollars, there's a spread of 3,000 or, 4,000 between those two.
Right.
We're not really getting any more dollars, but the rate is changing, increasing, because our EAV is decreasing. It's counterintuitive, but that's how it's working.
Sure.
If our EAV was holding steady or growing, you'd see that tax rate steady or dropping.
Go the opposite direction, okay.
Which has been the experience, I
Right.
think, of all districts for the past, 15 years, have seen growing EAVs and then tax rates dropping. Now we're in the exact opposite paradigm, where EAVs are stalled out and going down, tax rates are increasing again.
Okay.
So as, just one other thought, with respect to like the existing B&I levy, bond levy, theoretically, in the world of all theory, if we did nothing with respect to issuance, and we just allowed the existing bonds to roll off and mature and pay off, then effectively that tax levy would disappear to taxpayers.
That's right.
So extending it extends the levy.
Exactly. Okay, going to page 9, the first option for non-referendum bonds is.
Can I ask a quick question?
Yeah, sure.
It's not an increase, it's a continuation.
It's a continuation, right.
That's all. Thank you.
Okay, page 9 shows the option for $3 million of limited bonds, which in this schedule is issued in May, which should fit in well with the construction schedule you were talking about earlier, where you would get your specs and get your bids in March. And during that time, we would go through the petition period and public hearing and be ready to issue bonds when you're ready to start spending money. So the $3 million option, it goes out 2 years further than your current debt service to levy year 2017 or fiscal year 2019. And this debt is structured in such a way that it's paid off as quickly as possible based on our DSEB assumptions with regard to CPI. And so this is going to be the shortest way to pay it off. When you do that, you have the lowest interest cost. But you do want to think about, if I pay this off as quickly as possible, are there any other capital needs or projects that I'm planning to do before levy year 2017? So if there was, for example, in 3 years something you wanted to do, we might suggest a slightly different structure where, for example, if in 2015 levy year you would want to do another project, we would create a channel, if you will, to allow you to issue more bonds at that point. So it's just something we want to think a little bit about, you know, paying off. In the past, you've paid the bonds off as quickly as possible in every issue you've done. Since 2001, I think, was one of your first issues. But if you think you've got more construction ahead of you, then you might want to think about creating a little room for interest, a channel in your debt base to issue more debt, whether it's 2015 or 2016. We can look at those options.
Would that be at the same rate that we're talking here?
It might be slightly higher because if we create a channel to pay interest on new money, we would go out a little bit further. Okay, so the interest rate, instead of 2.65 that we've projected here, would be maybe 2.85 or something like that.
But, so say that again, instead of 2.6, it might be 2.8?
Yeah.
Okay, so it's still...
It's still going to be a low interest rate. It's just a matter of, you know, moving the bonds a little further
Is that
out.
because it's still locked into the original rate that we got?
No, this is a new bond issue. This is just because rates are low, you know, and I'm just kind of guessing on the 2.8% or 3%, but it's still going to be...
Whatever the rate was at that day, though.
It will be the rate on the day of pricing.
Okay.
And for those term bonds.
Right.
So the longer you make the term of any bond issue, if you move from 5 years to 7 years, you saw her page, I guess it was 3.
With a yield curve.
That yield curve.
Right.
The rates go up.
7-year rates are higher than 5-year rates.
Yeah.
Okay.
Okay, the next page is just a graphic of that.
I remembered my question, thank you.
Okay.
$3 million. That's a gross offering, right?
That is proceeds to the district.
Proceeds to the district? So, like in this case, there's capitalized interest of $73,000?
Yes.
Would we have to sell, you know, small amounts of premium bonds?
Yes.
And to cover
Cost of issuance
cost of
and
issuance
capitalized
and
interest.
capitalized
Yes.
interest and underwriter's discounts. So the full offering on a $3 million offering would be somewhere in the, like 3.15, something like that type thing.
That would be the amount of proceeds that we would generate to pay the capitalized interest, which you see, we've got $73,000 of capitalized interest.
Okay. We're doing, that's right, it's premium bonds as opposed, so the face would still be 3 million, but you've got a call protection.
Yes, we might suggest you make it a little higher, but premium bonds are really in demand right now, especially if you do a short bond issue like this that's non-callable. I think that would work out great.
And to take that out of the land of, you know, technical jargon, what that means, you know, to a layperson is, if I promise to pay you back, well, how to say it? Because it's really just an interest rate play, right?
Right. It's an interest rate play, and I'll explain premium bonds, but just so you know, the cost of issuance are all encapsulated in this all-in true interest cost of 2.65%. So let's say what a premium bond is where an investor pays you over 100% of the par amount. So let's say $3 million is the par amount, but we know we need to raise $3 million to pay cost of issuance and capitalized interest. So the investor pays us, instead of 100% of $3 million, pays us like 120% of $3 million. And in return for that, they get a 3.5% coupon as opposed to the 2.5% yield that is for that maturity. So when you offset the additional premium they pay versus the higher coupon you return them, the yield is the 250.
So put another way, and I'll just use $100 as an example. If I want to borrow, if I need $110, not 100, but I'm only going to pay back 100, but I'm going to pay it back with interest.
Right.
Right. So I'm going to pay $100 with interest at a higher rate, because if I was just paying you, if it was just $100.
Because you got $10 extra
Yeah, if it was just
up
$100
front.
between you and me, you would take, 2.5%. But if I'm asking you for 110 and I'm only going to pay you 100 of interest, it means I have to pay you 3% now.
That's right.
In other words, and that way you capture 100 in principal, but you capture additional interest to make up your yield.
Correct. Did you guys get that? That was a good example.
So
We'll
in
try
the
it.
$3 million example, is the 2.65%, is that with the premium?
Yes.
Or is that the part?
The
That's with the premium.
2.6% represents your all-in true interest cost with cost of issuance and capitalized interest, everything.
Okay.
So, try that again, because, all right, because I want to make sure I got it. I get 110 from Liz, but I only owe her 100. But because she gave me 110, instead of paying her 2.5%, I got to pay her 3.5%. And that way, she only gets 100 in principal, but she gets enough interest to make it up.
Exactly. Good. So here's the 3 million, and like I said, we go out to 2017, so about 5 years, and the picture of that is on page 10.
And that's really fiscal 2019,
Yes.
right? So in
Right.
budget years or fiscal years, we really is, I think, how we think.
You like fiscal years?
I mean, that's how we
Yes.
think. We
Yeah.
think
Because
in
we
terms
think
of
in
what
terms of
school year is
cash,
it, what
yeah.
budget year is it? You know,
Sure.
that's probably a more real, right.
Okay, sure. Right. And page 10 looks at the graphic of that. And so if we go to page 11, if we go up $1 million to $4 million proceeds, in this case, capitalized interest doesn't really do it, so we need to refund a tiny amount, in this case, about $113,000 of the outstanding bonds and pay them back with that $4 million. So this goes out to 2020 fiscal year, one more year, okay, for $4 million. So the next page is a picture of it.
So, but the 4 million is still a net number that comes to the district.
That's exactly right, 4 million proceeds. And then
And the
page,
interest rate goes from 2.69, or from 2.65 to 2.69?
yes,
Thank you.
right. Okay, then page 13 is the 5 million. Now we go out to 2021 fiscal year, and the interest rate's up to 2.77%. We have to refund a little more debt service to make room. And I will just say, another option you could use is funds on hand in the debt service fund, which Kim and I can probably talk about, see if there's any flexibility there. Because the bond, the fund balance, if you have a big fund balance in that bond and interest fund, pretty much the only thing you can use it for is paying bonds. So sometimes we can use that money as opposed to doing the refunding and lower your cost a little bit. But we have to be very conscious that we don't draw that fund balance down and leave you short for your cash flow purposes. The other thing, you will earn interest in that bond and interest fund, and that interest can be transferred out, so we probably don't want to use that. But to the extent there's, accumulation of loss collection or any of those types of things, we might want to look at using some of those funds to offset the refunded bonds.
And you're referring to the, the existing bonds we have now? And
The existing fund balance you have.
Okay.
Because the county clerk, I believe they add, what, 1% or 1.5%?
Yeah,
It's not a lot.
Yes, for non-collection, so they actually levy a little bit more than what you need, because they assume that you might not collect everything.
Right.
So even that 5 million is at 2.77%?
Yes.
And you're saying that could possibly be less if we're able to utilize this mechanism?
Yes, it would reduce your total debt service costs, reduce some of the refunding that we might have to do if there's some additional funds available in that debt fund.
But the question was, does it change the percentage? Does it change the
interest rate?
277?
Yeah, I think it would go down a little bit.
I mean, we're,
Not a lot, but.
yeah, I mean,
Yeah, by a
we're
little
going
bit,
from
like 1 or 2
2.6
basis points, yeah.
Right, we're going from 265 to 269 to 277. I mean, they're not
Yeah, not radically
huge
different.
jumps, but.
And again, paying it off as quickly as possible to use up the base, to keep the rate low. So, but in this case, you're, not really availing yourself of additional non-referendum bonding power till 2021 fiscal year.
And just to say that out loud again, it means that we've run the well dry for 10 years.
Yes. Now, we could refund some of this
Yeah,
bonds
I
if
mean,
we
you could
say,
create
oh my
that.
gosh, I
Yeah,
got to do
right.
something here in 5 years. We have this project that we didn't anticipate. So it's kind of a.
It continues the ladder, in terms of
Right.
continuing to pledge future income.
And it's kind of a hard decision because let's say you think you have a project in 2015 that you need to do, but you're not sure. So if we leave room for that project and you don't do it, then the debt service will go down a little bit and you'll have a decrease perhaps in your tax rate. And we could have paid those other bonds off faster. So, I think if you're not sure, maybe the better approach is to pay it off as quick as possible like you've done in the past. But if you are sure you're going to have a project in the next 3 to 5 years, maybe we make a little adjustment for that. So
$5 million is the maximum in bonds that we can take out for the life of these bonds. Is that correct?
well, this is a $5 million option. We can go out 20 years as a maximum.
Right.
Okay, that's the maximum. And I think I did that option for you last time I
Right,
was
you
here,
did.
and that amount is like 13 million without referendum. The only negative of doing that is that you're really kind of locking up your
20
debt
years.
base for 20 years and kind of reducing your flexibility.
But this way, there's still flexibility for the future should other projects come along. We're only right now looking at the amount, the range that what we're looking at for the projects that are in front of us.
Right.
We're not looking at maxing out our capacity.
Well, no, we are maxing out our capacity just only for 10 years, not for 20.
For 10 years, not for 20.
Right.
Yeah.
So
Right.
like if we did 5 million, I mean, think if we did 3, it's 8 years, but
Right.
let's just say we did 5 million for the sake of discussion.
Right.
We're maxing out our bonding capacity until 2021.
Right.
There's no more. If something happens or there's some financing you can do, but
Yeah, we can.
Because the challenge, just in visceral terms, and you've said it, but I want to say it in visceral, really just sort of gut level terms, is if we raise $5 million, then we have $500,000 in working cash now. And if we avail ourselves of $1.2 million from the Illinois Capital Development Board, that's, $6.7 million. If we spend, that's effectively all the money we have for capital stuff for 10 years. I mean, theoretically, you could go dip to the well again in about the 6th or 7th year, and pledge again the future. But all you're doing is pledging the future each time you do that.
Right, and
So
we have
if-
been conservative on our CPI
Yeah.
too, so if you
No,
get
I understand.
a few threes, then we've got a little more
Yeah.
to play with.
We
So-
get some new growth in there.
Yeah. So in terms of what's happening with non-ref, referendum bonds, is so if we get into a situation where we continue with operating negatives and stuff, like theoretically, if we let the existing bond issue roll off and we had, big operating negatives still, we could actually borrow that money as working cash to help fund operating costs. We're precluding ourselves from those options by doing this now, by doing this particular approach now. Is that fair?
Well, again, it depends on how you look at it. I mean, it can be restructured to still maintain that
So like
flexibility.
if like the capital project funds that we had in the past, or the ones that we usually get, they are assigned to specific types of jobs, does this have that same kind of string to it?
Right, if the intent is the projects, then you need to, pay for those, complete those projects and pay for those projects.
You can't midstream go, oh, wait, I want to do this with it instead.
Right, I mean, that's, right.
Okay.
Yeah, as long as it's a capital project, you're okay. Like if you decide to change that capital project, as long as it's still capital, you're okay, but you can't issue it tax exempt and say it's for capital and then say, oh, we want to use it for our operating budget. That's what you can't do.
Right, and that's what we're here talking about, these specific capital projects that we've been discussing all along.
Right.
So that's what we're looking at right here, are looking at financing these capital projects.
Got it.
Liz,
Thank you.
if the interest rate went up, we're at 2.77, say we waited 2 years to do this project, and the interest rate went up a full percent, how much less money is that to the district? I mean, how much more are we paying in interest because we waited and the interest rate went up?
I can run that for you and get back to you on that. I can't do it in my head very well.
Okay, I didn't know if you had it. I was just curious.
Yeah.
'Cause,
But if you do wait a couple years, I mean, you do have a couple more years, available under the base. So that's a good thing. But then you've got inflation on your project, and you have the risk that the interest rate market's going to increase.
Right, so kind of balances itself, okay.
Yep. Page 14 just looks again at the graph showing the levy years through 2019, which is fiscal year 2021. That's for the $5 million. So, the advantages of non-referendum bonds is obviously you don't have to go to referendum, and it's hard to look at referendum at a time when the economy is hurting, unemployment is still high, housing values haven't come back. Not to say it's impossible, it can certainly be done where there's a need, but it's a lot of work. So that's one of the advantages. The issuance of limited bonds, I think another advantage, we've talked about this already, extends the payments at the same level plus the CPI factor, but it's not an increase per se. And then limited bonds can be issued immediately, taking advantage of this low interest rate market. The disadvantage is that if you need more than, 5, 7, 13 million, you really can't fund that out of your debt base. That's where you have to look more to the referendum options that we were looking at earlier this summer.
You just said if we go past 13 million.
Yep. Mm-hmm.
Okay.
Well, if you,
If we go past 13, then we're locked into the 20 years.
Right. We don't want to, right, and we're saying
Right.
that's kind of a lot.
Right.
But even past that, you'd have to look at other types of
Right.
financing options.
Okay.
So Liz, as the dollar amounts grow, so do the years to pay it back?
Exactly.
Okay.
Yeah, okay.
So, for instance, if we do 5 now, if we need 10 in 3 years, that's 15 total. We're pushing all of those obligations out.
Right.
And those taxes that people have to pay out for a very long time.
Yes. Right.
So in most districts with a dollar amount this size, and what we're trying to do with it, I would guess that the non-referendum route is a more common route that school districts utilize, especially for this.
Absolutely.
It's kind of a smaller amount in my
Exactly.
mind.
Yes. If they have the debt service extension base and the capacity like you do, they absolutely will use that rather than perhaps going to a referendum. And you're lucky to have this. Actually, there's many districts who don't have a base at all because of where they were when tax caps came in.
So if I can ask just one question as we're moving into the next group, and tell me if I'm correct on this. So if we were to go for bonds, okay, we could get all the money that we need for our facilities that we're talking about right now, right?
Right.
At this guaranteed low rate, right? Because we'd be kind of locking it in kind of
It's
low.
the best estimate of
Right.
the rate on the day we
Right.
issue. But
Right.
yes,
And-
I wouldn't call it guaranteed.
No, okay, okay.
Best estimate.
All right, fair enough, that's why I'm asking. But looking at the chart that you provided for us, historically.
Historically,
back-
we're in a very good place.
Yeah.
Yeah. And
So-
these rates reflect what we're experiencing in the market today.
Right.
Things can happen.
Things
Right.
can happen.
So, and then that is done without raising taxes, right? Because we're not raising any taxes. And we still have plenty of capacity for future capital projects. Am I
You do have capacity, absolutely.
capacity? So that summarizes where we are so far?
Yeah.
Am I right?
Yeah.
Okay. And like you were just saying, we are fortunate at this time in our district that we have that capacity
Yes,
to do that. In these times.
right.
Okay.
And really, you are to be commended because your past issues have been paid off really pretty quickly, 7 to 8 to 9 years. And other districts might say, oh, I want to do the whole 13 million, and then they do it, and then they're stuck. And then future boards look at past boards and say, wish we had some flexibility.
Yeah, that becomes the good news is we have that because historically, the district hasn't issued long bonds.
right.
As we get out, for our district, having bond obligations that go 10-plus years is something we haven't done in the past.
Right.
And, looking ahead, you have each time you do it, you reduce your flexibility by whatever you went to the well.
Correct, yeah.
So the issue is at some point, 3 to 5 years from now, hopefully we don't have really big problems at the high school or the junior high or other places that are going to cost $2 to $10 million. Because at that point, we don't have anywhere to go. We have to go to some other question. We have to go to some referendum type question to find those dollars.
Right.
So as of right now, I guess it's in our best interest to prioritize what we're doing
Right.
with our money, with our capacity,
Right.
our money at hand. Okay, great, thank you. I just wanted to
Good point.
kind of look at where we're at so far. Okay, great.
But as time goes on, if we were to receive these proceeds today, and as time goes on, you're paying that down all the time, so 5 years down the road, right now we have a total of, say, 13. We take out 5, we have 7, but down the road, you're paying it off, you still may have a larger, if something were to happen, we still have capacity if we use this amount right now.
That's right, because every year you pay off, you get another year at the end of the schedule to kind of extend that 20-year window.
Oh, yeah, okay.
Well, and her schedule outlines the capacity question, right? So on page 13, which is the $5 million thing, our capacity on referendum debt service, out to 2020 is $4,243 in that year. And obviously, as it all rolls off, then all of a sudden, then in 2023, you've got $1.4 million of debt service capacity
Right.
that you can borrow against. But again, if you continue to go to the well, that as you point out, other districts are in this spot where all of a sudden you don't have that capacity to borrow against anymore.
Right.
At some point, if you borrow enough against the B&I levy, you force yourself into positions where you have to go to referendum.
That's right.
So if you look at this chart, that same chart, so let's say, 2 or 3 years down the road, our capacity got, larger, so to speak, so you go out further years in what you're able to do with your money, because you've been paying off for a number of years.
Right, those years get replaced on the end and at a higher level because you'll have a CPI factor. So
Okay.
that is a nice flexibility.
Okay, great, thank you.
Historically, Liz, what did you say we've done historically?
You've kept your bond repayment short.
Right, and what is short?
Short is less than 10 years, really, 5 years, 7 years, that kind of amortization schedule, so that you can have these conversations every, 3 to 5 years about extending and then consciously keeping that debt short, I think is helpful for future flexibility, and the rating agencies appreciate that as well.
Right, okay.
Yeah.
Thanks.
Okay, going to section 3, we've got 2 referendum options basically for you to look at here, and I know we're kind of maybe more inclined with the non-referendum options based on your projects considering now. But option 1 is if you went to referendum in March of 2012 for 5 million of bonds, 5 million referendum bonds. Those are not paid from the debt base, those are paid from their own separate general obligation bond and interest levy. So that capacity in your debt base is still there for you in this case. And we did those options for 10, 15, and 20 years. The second option is to go to referendum to increase your debt service extension base from 1.1 million up to 3 million. And the idea here is that then we'd issue 5 million bonds and we'd be able to pay those off, and instead of 7 years, 4 years, and have a bigger base to leverage more projects in the future. So let's look at the tax impacts and the advantages of those. Page 18 just kind of looks at advantages of referendum bonds, which is that they're straightforward, it's for a stated project, which is described in the referendum question, and the bonds are a temporary tax increase because once they're paid off, that tax rate goes away and you can't extend them like your DSEB bonds. That's just one and done. The advantage to increasing the debt service extension base is that the debt base is permanent. So if you go up to a new level of debt base, in this scenario we said 3 million debt base, that is always there for you even if you don't use it, and the taxes and the tax rate and the payments go down, you can go back and use it sometime in the future. So that's the advantage to really the debt base. It's always there for you.
Liz, both of these options here, these are both actually property tax increases, right?
They are indeed, yes. Mm-hmm.
And Liz, how is the payback structured when it comes to a referendum bond? How long is it on a tax bill? Is it?
And it's completely up to the district. It's up to you to choose that amortization. But typically, the bond repayment matches the life of the assets being financed. So I'm not 100% sure on all your projects you're doing right now, but bricks and mortar typically have, a 20-year life. Roofs or technology might have a shorter life. So we want to consider those things on the debt repayment.
So on a bricks and mortar project with a 20-year life, what are you saying that means for the tax?
That means you can pay your bonds back over 20 years.
That means it would be on the tax bill for 20 years?
Yes. Mm-hmm.
Okay, thanks.
Mm-hmm. Page 19 just looks at upcoming calendar for referenda, and the election dates is, March 20th for 2012, then November 6th, 2012, and then April 9th, 2013. Those are kind of our next 3 referendums.
Can I backtrack just for a second?
Sure.
When you're talking about increasing the debt service extension base, is that like its own separate line, or is that added on to what we currently have?
It's added on to your existing. It's added on to your existing.
So you would always want to have some degree of that in use, right? Or you have to use it?
You don't have to use it, but
does it
if you ask
disappear?
for it, you might as well use
Yeah.
it. It does not disappear.
Okay.
That's the beauty of it. If you get all your projects done and your bonds are paid off for a couple of years, you can just let that thing fall off. The only downside to that is if you have a project then coming up in the next few years, the taxpayers will say an increase from it.
Right.
But you won't have to go to referendum or anything. They'll have already authorized the debt base increase if it's successful. but you might have a little bit of a roller coaster in your bond payment and your bond tax rate.
Okay.
Going to page 20, this is the $5 million referendum-approved bonds with a 10-year payback. And the 10-year payback, and we did level debt service, and level debt service is like a mortgage, the same amount of principal and interest a year, and we recommend that for a district where, you know, you don't see a lot of growth, to say the least. Okay, so you can see the tax rate is about 16 cents. The payments are about $650,000 for 10 years, and the impact on the owner of a $300,000 home would be $149
A year.
a year for the 10 years. Mhm.
So a $200,000 home or 210, 70% of that would be about $100 a year.
Yeah,
In increase.
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 For 10 years, in this example, for 10 years.
Exactly.
And then it falls off.
Right.
I have to ask you a question that I don't know if you're going to be able to answer. What does the impact look like on my tax bill if we went for a bond, paying it back in 10 years? $5 million bond. Let's just say $5 million.
So your question is on your tax bill?
Yeah, what
Yeah.
what does that look like?
Well,
on
it's going to
on
be a 15-cent increase on your tax rate.
Right.
Okay, so, not having your bill, I can't really do
Yeah.
it in my head. But what's the total tax rate in the district, on your tax bill for all taxpayers? What, is it $7, $8?
I don't even know.
It's closer to 5.5 or something.
$5.50?
Is that all? Okay.
Yeah,
That's pretty good.
Actually, we're among the lowest in DuPage.
Okay.
Yeah, I don't have that with me. I just looked at it today and,
I'm just curious to,
the district's tax rate is like 371.
Yeah, and we're 70%
Yeah,
of
and
a
we're
tax.
maybe $6 somewhere
Okay.
in there.
So you'd be just adding $15 cents to that tax rate. And so as a percentage, that's pretty small to your overall tax bill. But, if you're looking at just what does that 15 cents cost an owner of a $300,000 home, it's about $150. If it's a $100,000 home, that's more like $50, and you can just kind of go up and down.
Right, okay.
So if it's a $6 tax rate total on a $200,000 home, or 210, right? Divides by 3 easily. So it's $70,000, 700, 6 times. It's a $4,200 a year tax bill today, right? 15 cents on that goes to 4,000, so 4,200 to 4,305.
So 105.
105.
$105. Okay. Thank you.
Sure. The next option is, again, that $5 million, but this time we're paying it back over 15 years. So there's more interest over time, but the annual payments are lower. In this case, they're only like $467. So the tax rate instead of 15 cents is 11 cents, and for that $300,000 home, that's $106. So you can see the longer we take to pay it off, the smaller the annual payment, but the more interest you're going to pay over time.
And the interest rate went from, just the 5 years went from 3 to 3.45.
Right. And then page 22 is the 20-year payback, and you can see that's an annual payment of around $385. The interest rate, though, is up to $382, and it's about $88 on the home. So with a $5 million issue, it's not going to be terribly expensive to the taxpayer, but going to referendum in itself is something to explain, and it is an increase as opposed to extending your current taxes.
Is it safe to say because it stays on the books longer, you're actually paying that $88 longer?
Yes.
Even though it's a smaller number, you're extending how long you have to do that.
Right.
Just same idea as dipping into the non-referendum B&I levy. It's the same idea. You're just paying the taxes longer.
So the advantage is that if you go referendum, you're leaving your limited bond capacity open for future use. But the disadvantage is that the time and effort to pass a building referendum is in a difficult economy. That's kind of a challenge. And then, of course, it does increase taxes.
So to talk about that advantage just for a second, so effectively, if you did a $5 million bond issue via referendum, and you did it over a 15-year period where you had $100 per $300,000 house, if you had an approval from your constituents, at that point then, the B&I levy that we have, which effectively clears off in 2015, I think, is the levy year in 2017. All of a sudden, all of that flexibility, all of that levy is available to us for other projects or for other needs in the district, including educational needs or operational needs.
That's correct.
And you can also do it the other way around by going to referendum several years down the road and getting an influx that way, because either way you're going, it's whether the referendum would get approved now or later.
Right.
In the referendum bonds, though, it says that you have to be specific on what you're stating it for. So if something did happen and we did run out of operating funds, we wouldn't be able to dip into any of that money for any reason. Is that correct?
Not of the referendum bond proceeds.
Right.
Right, okay. Not that I would want to, I'm just wanting to, there's
Right.
no flexibility there. This money is for this period.
Yeah.
Exactly.
It's very specific, and that, that's actually kind of attractive.
So again, going back to that, when we talk about the bond, when we look at this, we're talking here about the reason that we're using it. We're having a limited amount for these projects, and yet there's flexibility to use it again, to go back and if there's projects in the next couple of years, because we haven't reached our capacity.
Right.
In a couple of years, we would even have a higher capacity because we've already paid off some. And we have that money to use for the projects that we've been talking about here.
Now.
No.
I
And we
think,
get
Marie,
that.
it's not a higher capacity, it's longer.
No,
Our
I'm-
amount doesn't change, I mean, other
It
than
goes up by
CPI
CPI,
growth.
just the
Right, but
CPI
that's,
growth. It's
I
very
mean, really,
small.
it doesn't go from $1.5 million to $3 million, you know, it creeps up by 100,000 or a little less than that.
Right.
So effectively, what you have is more years that you can leverage every year that we pay off debt.
No, my question went to, 2 years out.
Right, we don't have more capacity, we have longer. We have the same amount available, but we have, for example, 2 more years that we can borrow from our future boards and our future earning and our future student population. So it's not more money, it's just you can go farther
Additional.
into the future. Every
Right.
year you pay, you have 1 more year that you can
Exactly.
leverage 10, 20 years from now, whatever.
If projects come up, we have additional capacity to use, have that money available for us. Okay.
So as I understand it, the simple answer is if we did some kind of referendum, we effectively just we've retained the maximum amount of flexibility that we can have inside the other
Right.
bond levy.
Right. That's right. The next page, 24, looks at a referendum to increase the debt service extension base, and just kind of gave you the wording on the ballot because it's a little confusing, but it would simply say, can the school district increase the debt service extension base from $1,197,470 to, in this option, I use $3 million, okay? So it's increasing it about $1.8 million from where it is. And Kim and I were talking about what number you could use, and really it's anything. You could make it less than $3 million. I think the option I showed this summer, we made it $4 million. But if you're going to go to referendum for this additional flexibility, we're thinking you should make it work for you, not only now, but in the future. So that's kind of why I chose $3 million. You could just make it $2 million or something, just increase it $800,000 or some small amount, but how much more capacity does that really buy you? Not a lot. So we can have those discussions at another time, but I just wanted to make you know that you can choose any number for that, and we just thought it was practical, if you're going to the voters, for an increase in that debt base to make it up to 3 million, so you have at least an additional 1.8 million to leverage.
But to give people a sense for scope, a $3 million, having $3 million available for debt service, if you did a 10-year issue at 3%, you can borrow $25.8 million, as opposed to, I just did it out.
Well, this is the only thing, though. You do have to include in that 3 million your existing debt service.
No, I understand. But like if it was just a clean $3 million, you know, you have
It's a lot of
capacity of
nice
about.
flexibility.
Yeah, it's $26 million, as opposed to at 1.2 million or 1.1 million, it's 12 to 13 million today because we've got this
Right.
5-year thing, so.
It's a good amount of flexibility. So page 25 looks at simply how this would work, and the only number I want you to look at on page 25 is the 3 million in the green box. Because if you went to referendum in March, you would ask for that increase, and it would affect that 2012 levy. So you'd go from the 2011 levy amount up to the 2012 levy amount from 1,197,000 to 3 million. And then if you look over 2 columns to the green box, the long green box, you can see all that capacity that then is available to you. And that would be nice. Now, of course, using it has a cost. And what we're showing here on page 26 is if we did that same $5 million issue and we paid it off from our now new and increased by referendum debt service extension base. So you would go to referendum in March, hopefully successfully. You'd have that 3 million available to you. You would then issue 5 million of limited tax working cash bonds, paying them off as quickly as possible. You can see we really have only like 3 years we can pay them off if we're accelerating, paying it off quickly. And but go across the page to what that does. You're in fact increasing taxes via referendum by $1.8 million, so that is a 46-cent increase on the tax rate. That 46 is higher than it would be if your EAV was not decreasing, because that's hitting in that 2012 year where we're projecting a 14% decrease in the EAV. So if the EAV didn't increase at all, that might be 40 cents or 42 cents, but because the EAV is decreasing, it's 46 cents. And on that $300,000 home, that's about $458. So it is
if you went
expensive.
for a referendum if a district was to choose to go to the referendum with this debt service extension for this $5 million, a taxpayer would have $468 additional taxes.
If you paid it off accelerated.
Accelerated.
For
Yes.
$300,000 home, for the price tag of a house that was $300,000.
Right.
Right.
Right. Obviously changes depending upon the house.
Yeah.
But, okay.
And so I thought, just for something to contrast it with, let's say page 27, you went to the voters for that same increase in the debt base up to 3 million, but you said, you know what, times are tough, we don't want to use it all. We want to make the payments lower. Let's make the payments $500,000 a year, pay it off over the next 13 years, and then the increase is only 16 cents or $160 on that $300,000 market value home. But
And that's per year, right?
Right.
yes, that's per year. The issue here is, though, you still have all that capacity in that green box. And, someone could say, okay, this is great, you're going to do this $5 million issue, and it's only going to cost us $160, but I just authorized you the capacity to use another $1.3 million or $1.4 million, which you could at any time, and then my taxes will increase more. So, you could do this, it saves you flexibility in the future, but you kind of have a difficult message to tell people. So I just thought I'd throw that in there for discussion, as if it's all not complicated enough. But, you can structure the debt in such a way that you're not using all that base, but it's still there for you in the future. but it does mean higher taxes in the future. So just to summarize, the debt service extension-based referendum is an advantage because it permanently increases issuance flexibility for both capital and working capital. And if it's not used, it does not extinguish. It's still there for you in the future. The disadvantage is, again, the time and effort to pass a referendum, especially in a difficult economy, and it is more complicated to explain than a building bond referendum, and it increases taxes. So more options to consider, but I thought that might be helpful.
You talk here about the disadvantages. Obviously, everybody who reads the paper knows that it's a difficult economy. Talk about the time and effort to do that. I would imagine there would be a cost to that then, too.
Well, there really is a cost, and anyone, I know Kim and Kevin have probably both been through referendums at your prior districts, and the time, the cost is really, you know, your administrative staff has to spend so much time on referendum usually, you know, that they can't, that takes away from the educational program. It takes a good year to plan a referendum. It takes grassroots community.
I'm sorry, what did you say?
It takes a year, in my opinion, to plan a successful referendum. It takes a good grassroots effort and lots of communication with the community so they understand your need and they can support it or not, as the case may be. So the cost is in time and effort.
Thank you.
Thank you.
Thank you. Thank you. Thank you very much.
So basically what, you know, Kim and I need from the board is, you know, there are 3 options presented here on how to fund the projects. And, you know, the goal is to get projects, the short-range projects done over the course of the summer. And so we're kind of focusing on that. Steve Cashman, at this point, gave us, you know, pretty broad brush stroke. He could go as low as $3 million on them to $5 million. And so I think first off, the initial consensus, you know, we need to reach is, you know, the best way to fund those projects. Is it the non-referendum bonds? Is it, you know, the referendum questions? Which of those options? Because then we can, you know, if we're thinking non-referendum bonds, well, you know, Liz then can get working on her end. You know, there's resolutions that need to be drafted and those types of things, so that we follow on the timeline. If it's a referendum question, there's still, you know, resolutions that have to be drafted, paperwork filed, you know, all those things so that it gets placed on a ballot in time. So, you know, basically what is the consensus of the board of those options, what direction we want to head.
Well, Kevin, let me ask you this question. We've had a wonderful presentation here for the second time to our district. Can I ask if you and Kim, who have more expertise than any of us have in this, do you have an opinion as to what would be the best way to do this? I'm sorry if I'm putting you on.
I always have an opinion.
On this side.
You know, Kim and I have discussed it, and you know, for this size project, and because we have the capacity, it makes sense to us that you would do the non-referendum bonds. We would do that. You know, the midterm, long-term projects, I think we can have a different conversation. You know, especially if we don't want to tie ourselves up and limit our flexibility and possibly look at a referendum question for those projects. I think the nice thing about the way that it's been structured during the short-range projects doesn't, you know, there's nothing hanging out there unfinished per se if, you know, we want to put off some of those other projects or, you know, but at the same time, there's nothing that would have to be undone, you know, if you follow that. So I think right now, what makes sense would be to do the non-referendum bonds.
So one of the items that we talked about in the Finance Committee meetings when we first started those was the fact that we don't have a really strong, well-structured financial policy regarding how much debt we want to carry as a matter of policy and how we want to handle bonding and even the referendum question. We still don't have that. So we're essentially, marching towards using all of our non-referendum bonding capacity without ever sitting down as a finance committee or any financial group within the community and coming up with, these are in fact the guidelines that we as a community think are appropriate for how the district spends money. So at some point in time, we went to referendum years ago and got this base of bonding capacity, but we don't have a follow-up policy that then says, and this is how we're going to manage that capacity or that money. So, I think that that's something we need to revisit. We haven't had a finance committee meeting in a while. We haven't been, really focused on that very, aggressively, but we still don't have it. We didn't have it when we started that committee, and we still don't have it. And now we're faced with making a decision about the very thing that we agreed we don't have a policy for. So I'm a little concerned about that because I think, as Marie pointed out, we're not really the experts on some of this, and I think policy is there because you get a collective group of people together who help to determine what are, sort of the guidelines or the best practices, and we should really consider that as part of this process as well, because we're
right. And I do agree with you. I think that for instance, one of the considerations districts always have or think about, as Liz pointed out, when somebody looks at their tax rate, most people don't realize that their tax rate is made up of two parts. There's the operating rate and there's the bond and interest rate. And for just easy purposes, if somebody had a $3 tax rate and $2.50 of it is operating and 50 cents is bond and interest, when districts do pay off that debt, that does come off, and people notice that on their tax bill. And so then when a couple years go by and then, hey, we want to do whatever improvements, let's issue the non-referendum bonds, the 50 cents comes back on. And part of that thinking and philosophy that districts have sometimes is, you want to try to maintain that because, people are used to that. They're used to seeing the $3. And so then, and when it fluctuates, sometimes those are difficult conversations to have and explain and so forth. And so that's part of it as well, that conversation. And I think if we're talking about, going out for 10 million, or maxing out at 13 million, that I would not, in good conscience, be able to say, I think this is a good idea. But I think because we're talking about that 3 to 5 million range, I think we're okay with that. And then, but at the same time, yes, we have to have those conversations and all encompassing. What is where do we want fund balances to stay?
Well, because we've suggested in this conversation that if we only do the 5 million now, we'll have more capacity. Well, but the more capacity is going to the 13 million. It's going to the max of 20 years. It's going to that place that, we haven't really had conversations about whether that's appropriate or okay, or we as a community or as a board, support that. So again, I'm just concerned because what we're doing right now is, a reasonable interim, manageable amount of time and amount of money. But if we keep implying that, well, but, in a couple of years there's more or longer, or whatever word you want to use, the more or longer is effectively the max. And we don't have a policy that dictates whether that's okay or not and whether we should be counting on that 2 or 3 or 4 or 5 years from now. Mm-hmm. So, we need to get that under control. And I'm not implying that this particular 5 million or 4 million wouldn't be appropriate, but it's a slippery slope.
Sure.
Now we've used it all. Now we're going to have to go back and get more, and that's longer, and suddenly we're at 15 years, and suddenly we're at 18 years, and now we're at 20, exactly where we didn't want to be. So
before you get there.
Right.
Right. I just think, Liz has already pointed out a couple of times that in the recent history of this district, we've been fairly conservative about how we handle debt and what we issue and what our payback period is. And I don't necessarily think that this is the time to step away from that. So I just want to make sure that, we have a little more solid guidelines around what's we all as a district consider appropriate.
You know, you bring up a good point in that, you know, talking about policy and where we want to go in terms of debt capacity and everything. But I think from what we're doing here, one of the things that the reason that we're looking at this particular amount of money, this 3 to 5, is because we have been talking for a number of years about our schools and our facilities and what do we need to do for our facilities and prioritizing those needs. And I think over the course of many, many, many meetings, numerous people, our community has kind of said to us, as an administration and as a board, these are important to us. These projects that we're talking about, that this money reflects, are important to our district, and they have been talked about for years. So I think I like to hear, like what I hear about the fact that we can go for this money at historic low interest rates, get this money, does not increase our taxes, and in the end, we have done what our community's asked us to do many times. We are addressing.
So, you know, Marie, my comments aren't about the projects at all.
Right.
This is a financial management question, and it's about fiscal responsibility. My comments have no bearing at all on any project we would spend a single penny on. They're not related to that. This is kind of the bigger picture, longer term. We need guidelines and a policy to follow because there will always be more projects. There will always be more things that we all want to do. And our short-term projects, I'll just use one example because I think it's a pretty high dollar example. In the midterm of the project list is classrooms at the high school, real walls, which right now today is not the highest priority because our enrollment, we're in an enrollment period that's slightly smaller. 3 years from now, we're going to hit that bubble that exists right now at the junior high and the upper grades of the elementary. All that space is going to be needed. 3 years from now, that's going to be a priority project, and I don't know the dollar value, but I mean, we've been told repeatedly that that's an extensive, expensive renovation because of mechanicals and all of that. So I'm just, you know, it's about having a policy to say this is about the amount of debt, these are the guidelines of how and when we issue and why. It's not project related. It doesn't, I'm not trying to diminish in any way any of the things we're trying to do right now. I'm trying to look at the bigger picture.
And I guess
That's all. Not project related, not trying to take away from all of the facilities work. It's strictly a finance committee, financial management, fiscal responsibility question.
But I just wanted to bring it back to the fact of what we're here for now, or what the direction that we're looking at now is based on what is in front of us. And one of the things that we're hearing is that should we have future projects that are on the mid and long-term plans, that there is capacity there. And what we've just heard too is that doing this right now does not preclude us from future referendum.
So you characterize it differently than I would.
Okay.
I guess I'll leave it at that. Okay. I mean, essentially, you know, it's saying, well, we'll go up to the max if we need to. Well, yeah, you can always say that. In all of our lives, we can say that too.
Yeah. No,
I don't want there to be any confusion. It is not about the projects at all in any way. Financial management and fiscal responsibility is a long-term effort, not a today's project or today's, you know, flavor of the month.
Sure.
It's just not.
And I think one of the current concerns that well, not really concern, but something I think about as you talk about that is like trying to establish these long-term kind of views in policy. You know, those are all subject to change every 2 years when there's an election and there's a new board sitting here and they may say, hey, I don't like that policy, out the window. So I think what we're doing here and the way we're looking at this and managing it is a very responsible way. And I think part of the policy, if you want to call it that, although it hasn't been, you know, written down and adopted, is our discussion that's going on, you know, right now. How much do we want to use, and being cognizant of, you know, future needs for future boards. So I do think in some way we are having that conversation that you're looking for, but I think you want something very well defined, if I'm understanding.
This is a conversation about money for projects. I want a financial conversation that we discussed at the beginning of this school year was needed. We all agreed it was a needed item. It hasn't happened. That's what I'm looking for. Not we would like $5 million for projects. Great, we want $5 million for projects, that's great. But in the bigger picture, we stated at the beginning of this school year that this was an important item, and we haven't done it, and now we're in a situation where we're going to be voting on, 10 years worth of debt. So again, not project related, not about whether this is a responsible or irresponsible thing to do. It's about the fact that at one point we said we need this, we still need it, we haven't done it. Here we are faced with a decision. So it's really just getting that into the discussion more than anything.
Any other?
Well, I just to look at it from a different spin, I guess, not so much the policy question, but as a longtime resident here, I can tell you, as Marie pointed out, the community's been talking about doing things with the school district for a long time. And it seems like there's a certain amount of frustration out there that nothing ever gets done. We've talked about it at this board table itself. Nothing, it seems, ever gets done. So here we have an opportunity to not raise anybody's taxes, improve our schools in a down economy, which is a big improvement, not just for the students, not just for the teachers, but for the whole town. I think that's something we have to take more seriously, and I do think it's something we should act on faster than delaying. So I'm just going to add that.
Can you give your opinion?
If you ask me for my opinion, yeah, no.
I'd like to know your opinion on what do you think is the best way for us to go?
And I don't have your long-range financial plan in my head or the background. I think this is a great way to get $3 to $5 million of projects done this summer that are critical, that you've prioritized using your limited bonding. I also agree with your policy discussion, and I actually have worked with districts on policies and have some of those parameters that I could forward to Kim and Kevin so they could facilitate those conversations at finance committee meetings, because you're right, that is a different conversation. I think it's important and the rating agencies look at it, but I do think this is a great way to finance your $3 to $5 million projects.
Well, I think being fiscally responsible, frankly, that's where I'm leaning. I think it makes sense to do. I think we need to take advantage of these interest rates. I don't know that we'll ever see them again. I think these projects are going to enhance the academic experience of all of our kids, and I think it's been a long, long, long time coming. And I'm not willing to wait. I don't want to wait anymore. I want to get started on these projects once and for all. That's my thoughts.
I support the 3 to 5. I look forward to the longer conversation.
I'll touch two things. First, on the policy question, absolutely yes. We need one, and we need at a couple different levels, but more importantly to Kevin's question, because Kevin and Kim need direction, which is really about three choices here, and so I'm going to talk about those three choices. With respect to extending the base, first, premise, I'm always nervous about giving public bodies the right to encumber taxpayers with long-term debt. Give a public body a blank check, and they will use it. It's just how that works. So extending the base is just something philosophically I'm reticent to do. I'm reticent to embrace. So with that said, I think there's a certain inherent honesty in going to taxpayers and saying, we've talked a lot at different points in processes about accountability and transparency and listening to the community and all that stuff, and there's a certain honesty in going to them and saying, here's the things we'd like to do. They cost $5 million. For 10 years, they'll increase your tax bill by 15 cents per 100. And then after 10 years, that money will be paid off and it's gone. The disadvantage of doing that is that for 10 years, you have a higher tax bill, 15 cents per hundred. The advantage to doing that is that the district has retained all of its flexibility. We've been completely open and honest with you. And we've told you what we want to do with your money. So I think for me, the honesty of actually going to a referendum, is attractive. I also realize it is difficult and it is painful, and so I don't want to minimize that in any way, because it's easy to say things like we'll listen, and that's the ultimate act of listening is a referendum. We can listen to engaged people at meetings and engaged people on surveys, but the ultimate act of listening to the community at large is when people vote. The question to me really is this question of, do we want to encumber our taxpayers with longer taxes or shorter, higher taxes? Do we want to extend that base for 5 to 7 years and go out to 2020 where we tie ourselves up? Or do we want to simply go to the taxpayers and say, hey, look, for $9 a month, here's what we can buy? Right. So the other thing to raise, we haven't talked about operational costs of projects, so as we get into the conversations about projects, right, and the stuff that we ultimately we're building stuff to do stuff. So ultimately, we need to have the conversation about operational costs as well, because it'd be great to build stuff, but then, God forbid, we should not have the money to fund the programs that are supposed to fill those spaces. So that's that, and then just as a side note, I'm something of a interest rate bull and a bond bull. So the Fed's been pretty open about the fact that they ain't going anywhere with rates for a while. So I'm not worried too much about the next, 4, 5, 6 months with interest rates. So those are my thoughts. I lean personally toward doing just a very clean, very honest referendum for or for whatever the number is, 3 million, 4 million, 5 million, whatever that number is, a very clean, a very honest, dear community, this is what we want to do. The thing we have to wrestle with is if they say no, well, at that point, we could still issue non-refs. We could still do that. It just becomes difficult, So that's what's going through my head. I'm just leaning towards being open and candid, and let's just ask.
And I think we've asked. I think we have asked the question. I think the community has done their part in what we've asked them to do. And I think we have to do our job. We have to do this part of it. And this is not an easy part, this is difficult. But this is why we're here. So, unfortunately, if you go the referendum route and we don't get it, the projects won't be done by next year. And our goal is to have the projects done by the start of the 2012 school year. That's what we went into this hoping for. So if you go through the exercise of asking our community, which we've done, we're going to lose another year. And I don't want to lose another year. I don't.
One of the things that I think about when we sit here is we're talking about where we sit. One of the things that we learned in some of our videos that we've seen in our strategic planning and facilities is that we can't legislate for future generations. We can only take care of what's known now. And right now, again, I guess what I'll ask that question again is, so when we go for bonds, we would get all the money that we need for these particular projects for our schools. Right now, at these low rates, historic low rates, without raising taxes. And with the capacity for future capital projects. To me, I guess I'd have to say out loud, we can improve our schools immediately in a tough economy. I don't see any other option. To me, it just seems like, I have to agree with Mary Kay said, we talk about honesty and openness. We have had 4 to 5 years worth of facilities meetings. I think many people have weighed in on what the priorities are of our community. I think it's our job to listen to what our community is saying to us about particular capital projects that we're talking about here. I agree that we should be talking, we have future discussions that we have to have about operating, but our job here now in front of us today is to talk about our schools and what we're looking at. And some of the things on our plate right now are to enhance the academics of our schools, of our students' ability and their day-to-day life. And so I just, as far as I'm concerned, I'll say it again, I just find that neat and clean, go for this bond money, don't raise the taxes. I couldn't even fathom asking people who are perhaps out of work or struggling on a day-to-day basis. I mean, we all know how difficult, absolutely difficult it would be to go for a referendum at this time. I think, and in closing, when we took our oath of office, we swore to respect the taxpayer interest in serving as a faithful protector of our school district's assets. And so on that note, I would say that your presentation and our recommendations from the superintendent and the business manager would be to go for the bond money. So do we want to go around the room? Is there any other comments?
Hang on 1 second, Maria. I just want to.
Well, let me first, do we still need Liz to stay?
I'm sorry, I'm just kind of standing here waiting for questions.
Stay there, Liz.
We can cut Liz loose if everybody's comfortable with that.
Thank you again. Thank you very much.
Thank you very much.
Thank you very much.
Thank you, Liz.
Liz. Thank you, Kevin. Okay, Joel, I'm sorry.
You know, I've been thinking about this obviously for quite a while, and I kind of went back and dug up an old article that I knew I saw quite a while ago, and it says, district may put in to open classrooms, and it's talking about the development of a facilities committee and looking at district priorities and some of the larger projects at the high school, and it's dated 08, January. And it's almost January of 12. It's 4 years later. We're still talking about many of the same concerns we had 4 years ago. And we've had 2 committees, facilities committees, over those 4 years that have come to the same conclusions of what some of these priorities are. I think we have done a fabulous job of keeping these priorities academic focused and to benefit academics, to benefit student achievement. You know, the early childhood center and, you know, hopefully being able to expand those services, that will mean a world of difference to many of our students. And hopefully we'll be able to expand on other programming as well, like you mentioned, Marie, maybe full-day kindergarten or some other things that will also lead to increasing student achievement. I think that is our charge, really, as a board. That is our prime concern. So we have talked a lot about these particular priorities, but I think we've done a very good job of streamlining them to our children's, our students' classroom experience, which is absolutely critical. One element to going to the non-referendum bonds and kind of kickstarting this project, because obviously we have many projects, mid-range, long-range, that'll take a lot of money, is I think it will demonstrate, and in a very visible way to our community, the priorities that we put in place through where we spend our money. And I am for using the non-referendum option. I think it will give our community, it will help build trust in our board to say, hey, they did what they said they were going to do. They spent the money on the priorities that the community outlined through 2 separate facilities committees, and I trust them. I trust their decision-making. So down the road, if we have to go for some sort of referendum option, we have built the trust that's necessary for success in the future. I think that's a very critical component here. I mean, the feedback I have received, I don't know about other board members, but, you know, you ever go door to door knocking on doors during campaign season, the door opens, first thing out of their mouth, you're going to raise my taxes, aren't you? There is, you know, that perception out there that school boards, that's all they do is raise taxes. So I think it's nice to be able to say, we're holding the line, we're working with what we have, we're living within our means, and we're still going to enhance our students' academic experience and enhance the classrooms, and hopefully that will lead to enhanced relationships between the teacher and the student, because that's where academic progress rests. So I think it uses our resources wisely. I think we are being very prudent about the dollar amount, and we are leaving capacity for future needs. I feel referendum, you know, is a discussion for larger projects, more comprehensive, dollar amounts bigger, you know, because we wouldn't want to do, to me, I wouldn't want to do a referendum now and then say, hey, now we want to do walls, let's do another referendum. So, you know, we really want to, in the further discussions through the strategic planning, the facilities committee and the initiatives there over the next year, 2 years, really define those needs. I also think it's going to be valuable to go through that, I keep saying this wrong, is it EPERT process that we talked about, to look at programming and look at where we spend our money and say, can we get more out of what we currently have? Can we spend differently and improve the learning experience? I also think it's important that we have the money up front to utilize and fully utilize the $1.2 million of the Capital Development Board grant. I mean, that would just be, you know, a disaster if for somehow we lost that free money. I also think the projects we have outlined, and I don't know where the status is. Kevin, you talked or mentioned a little bit about the early childhood grant. That process is still, the grant is still being put together.
Correct.
So, you know, being able to put into that grant paperwork and mention something about the board is committed to an early childhood center may give a favorable, you know, review of our grant paperwork, and they say, hey, they're on track already, and they can do so much with, you know, so I think that is something to think about as we kind of, you know, come to a consensus here. I believe that is mostly it. Frankly, I'm excited to finally be moving forward with something, and I think really once these things get rolling, I think it will build additional community support. You know, they made this happen, hey, maybe we can do the walls project at the high school, or maybe we can, you know, do some other facilities upgrades that we still will need down the road. So those are my thoughts.
Anybody else then before we?
Yeah, just.
Okay, so we'll then go around and just give your opinion as to what you would like to do. So, Mr. Armstrong?
I would like to go for the non-referendum bonds.
Dan?
The referendum with the just specification of the bond amount.
I would like to go for the non-referendum bonds.
Okay. Shannon?
Me?
Yes, you.
I support Kevin and Kim's recommendation with the caveats I've already stated.
Joel?
I would like to go for the non-referendum bonds.
I support Kim and Kevin's statement, or the non-referendum.
Okay. And I'll say the same thing. I agree with the non-referendum bonds. Okay. Did you need anything else from us then tonight?
No, not for tonight.
Tonight, okay. Okay, thank you. Then the next item on the agenda. I wanted to, one thing, it's not on here, board reports, but I just, if I may, I wanted to mention that this Friday and Saturday is the Westmont High School Theater presents the play Happily Ever Once Upon. And it sounds like a fabulous play. From those that are working on it, I hear it's going very well. And so the play is Friday, November 11th, Saturday, November 12th at 7 o'clock. And you can go to the website, whsfinearts.org, and reserve tickets for that. So another example of our student body working very, very hard. So that was, I just wanted to kind of bring that out. And as long as I have said that, does anybody else have anything that they wanted to add to that? So, okay. Public comment. Are there any public comments? No? Okay, then the chair will entertain a motion to enter closed session for the purpose of discussing legal issues.
So moved.
Second.
Roll call, please.
Ms. Caparelli?
Yes.
Mr. Charleston?
Yes.
Mrs. Charlton?
Yes.
Mrs. Hancock?
Yes.
Mr. Price?
Yes.
Mrs. Thomas?
Yes.
Mr. Armstrong?
Yes.
No.
And there will not be a vote after closed session. Thank you.